Understanding markets is only part of investing. The more important question is how exposure is actually implemented within a portfolio. This video walks through a hypothetical portfolio case study to illustrate how professional investors might think about allocating Saudi ETFs alongside other global assets. This is not a recommendation or a model portfolio. It is an educational framework designed to demonstrate professional decision-making. Professional portfolio construction always begins with objectives. These include return expectations, risk tolerance, time horizon, income needs, and diversification goals. Allocation decisions are made within this broader context rather than in isolation. In this example, consider a diversified portfolio designed for a long-term investor. The portfolio already includes U.S. equities, developed international equities, and broad emerging market exposure. The objective is steady long-term growth with moderate income generation and controlled volatility. The first question a professional investor asks is not how much return an asset might generate, but what role that asset is expected to play within the portfolio. Saudi ETF exposure is evaluated through this lens. Common reasons professionals consider Saudi exposure include diversification away from technology-heavy global markets, exposure to energy-linked economic activity, income characteristics from banking and infrastructure sectors, and geographic balance. Once the objective is defined, position sizing becomes the central focus. Professional investors rarely introduce single-country exposure as a core holding. Instead, Saudi ETFs are typically introduced as a modest allocation designed to complement existing exposures. In this hypothetical case, a professional might consider allocating a low single-digit percentage of total portfolio assets to Saudi exposure. The exact allocation is not the point. The principle is that exposure is sized conservatively to manage volatility and country-specific risk. Sector interaction is then analyzed. Saudi ETFs often have meaningful exposure to energy, financial services, and telecommunications. Professionals examine how these sectors interact with existing holdings across the portfolio. If the portfolio already has significant exposure to global energy companies, additional Saudi exposure may increase concentration risk. In such cases, allocation size may be adjusted downward or positioned alongside other diversification measures. If income stability is a goal, exposure to Saudi banking and telecommunications may be viewed as supportive, provided dividend sustainability aligns with portfolio objectives. Liquidity and implementation considerations follow. ETFs are often preferred because they offer daily liquidity, transparent pricing, and operational simplicity. This allows professional investors to adjust allocations efficiently as conditions change. Rebalancing discipline is a cornerstone of portfolio management. Allocations are reviewed periodically to ensure they remain aligned with long-term objectives. If Saudi exposure grows beyond target levels due to strong performance, positions may be trimmed. Conversely, if performance lags but the original rationale remains intact, exposure may be maintained or reassessed rather than eliminated. This disciplined approach helps avoid emotionally driven decisions. Risk management is embedded throughout the process. Professionals do not attempt to forecast oil prices, geopolitical developments, or short-term market movements. Instead, risk is managed through diversification, position sizing, and rebalancing. Currency structure is also considered. The Saudi riyal's peg to the US dollar reduces currency volatility, which can simplify portfolio modeling and reduce one source of uncertainty relative to other emerging markets. However, reduced currency volatility also limits potential currency-driven returns. Professionals view this as a trade-off rather than a benefit or drawback. Time horizon plays a critical role. Saudi exposure is evaluated over a multi-year horizon. Short-term volatility is expected and does not typically prompt immediate changes unless the underlying investment thesis changes. Correlation analysis further informs allocation decisions. Professionals examine how Saudi ETFs move relative to U.S. equities, developed international markets, emerging market ETFs, and energy prices. Assets that behave differently under varying market conditions can improve overall portfolio resilience. However, correlations are dynamic and are reviewed over time rather than assumed to be static. Stress testing is another consideration. Professionals evaluate how Saudi exposure might behave during periods of global market stress, energy price shocks, or regional disruptions. This analysis informs position sizing rather than timing decisions. Importantly, this case study highlights that portfolio construction is not about finding the best performing asset. It is about building a collection of assets that work together to achieve long-term objectives. Saudi ETFs, in this context, are tools rather than bets. They provide targeted exposure that can enhance diversification when used thoughtfully and sized appropriately. For American investors, the takeaway is not how much to allocate, but how to think about allocation decisions. Clear objectives, disciplined sizing, diversification, and ongoing risk management form the foundation of professional portfolio construction. This framework applies not only to Saudi exposure, but to all international allocations. Markets change, but disciplined process remains constant. This content is provided for educational purposes only and does not constitute financial advice. For a structured guide covering access methods, ETFs, risks, income characteristics, and portfolio strategy, download the full Saudi market guide linked in the description.